Welcome back. You're watching Business Morning on Channels Television. So the markets are counting down. The Nigerian Stock Exchange is counting down to when most of the companies listed will begin to turn in their full year results. And so as earnings looms, we're taking a look at some of the equities listed on the Nigerian Stock Exchange. And as I mentioned at the beginning of the program, the first results that usually come into the market usually coming from the banks. And so we're taking a look at that today on the program with Wale Olusi, who is an investment research analyst with AfroInvest. Wale joins me here in the studios. Good morning to you, Wale.
Good morning, Harriet.
It's great to have you on the show today. So let's wrap up this week as we're counting down into the beginning of February. We've just got how many more days in January? Just about 2 days, Monday and Tuesday, and then Wednesday we're in February, and then the markets begin to expect to see full year results from companies listed on the Nigerian Stock Exchange. What are the immediate expectations from analysts?
Okay, so here's our expectation. The market is broadly a reflection of what is happening in the broader economy. So I think the IMF has already taken the first position, noting that they expect a contraction for the Nigerian economy in terms of GDP by full year. Our outlook for the year also indicated that AfroInvest were expecting about a minus 1.6%. Of course, all the numbers published by the MBS throughout the year has already noted a contraction for the last 3 quarters that we've seen. So we do not expect a divergence from what is happening in the broader economy. In terms of sectors, we think most of the sector in the economy will be challenged. Industrial goods, consumer goods, we're expecting that the direct cost of inputs, cost on their operations will pressure profitability. Also, many of the firms with a lot of foreign assets, foreign liabilities will also have finance costs to struggle with. So we think that's going to pressure their earnings further. So it's not looking like a good year for many of the companies, except for some of the oil and gas stocks, and of course Greek, who also, if you look at the composition of the GDP, every other sector but the Greek has maintained a decline in 2016. So we think the likes of Presco and Okomo can have a good year. Some of the downstream oil and gas stocks may also have a good year in 2016 because of, they're in favor of policy and the fact that, towards the end of the year, the likes of Seplat and, Rwanda might not benefit much because they have costs to struggle with.
But not the banks.
Yeah, the banks, of course. In 2016, it was a serious year for them. Like of First Bank, for example, have a Q3 impairment charge that is over $100 billion naira. Now I was looking at it this morning, and First Bank impairment charge alone is more than the entire thing that Fidelity Bank has made as a full year revenue in 2015. So it's a serious year in terms of asset quality deterioration for the banks. Impairment charges are spiking. Our full year expectation for the industry is about 12%. For a First Bank alone, they did about 22% as a Q2, except for the top tier 1 banks like the likes of Access, GT, UBA, which are our top pick. Of course, they are going to benefit a lot from foreign currency gains. Loan growth is pressured, but FX gain will also make nominal growth in loan, a positive.
But 2016 would definitely take the cap, take the top of the non-performing loans that were recorded in the banking sector, particularly definitely coming in from 2015.
Yes, that's correct. And 2016 NPL is going to near what we saw between 2011 and 2008, 2009, where the market was pressured by global financial crisis back in 8-9. Of course, the European market debt crisis, and we have some domestic pressures in the Nigerian economy in 2011. So in 2016, we are seeing NPLs going to double digits, close to what we saw back then.
And this will be worrisome definitely for the Central Bank of Nigeria, because I remember in 2016 for one of the banks that actually came up like that had such a high NPL, said you cannot continue to come to the window for us to bail you out. So it seems as if the CBN has a lot on its plate at the moment as well.
Well, yeah, definitely. The CBN has a lot on its plate. Where we think the CBN probably would have been more proactive is in terms of regulation, because what we are seeing now is a lot of unrestrained exposure to some very high-risk sector. When oil prices were high, we saw banks being exposed to upstream assets in the oil and gas sector alone to the tune of 40%. The likes of First Bank, the likes of ETI, I think Diamond was also a corporate, as well as FCMB. I mean, they have huge exposure to this sector, and when the prices plunged, it took a lot of toll on their asset quality, and that's what we are seeing today. So that is going to also have a direct effect on their CAR because of pressure coming from FX last year. The likes of First Bank, Diamond, FCMB, and when we did our simulated adjustment for what the CAR will be based on the devaluation we saw last year, we think they are going to close at about 15% for those that are international banks like of First Bank. I mean, just close to the benchmark that the CBN has ruled. Some of them might even be a little bit lower than the benchmark, maybe a Diamond, but I think many of them are already running towards raising capital so that they can maintain CAR within the regulatory limit. The likes of Sterling, for example, we think they may be having issue with maybe liquidity. So to forestall that, they've already made a very fast move. During the year, close to the end of 2016, they raised a commercial paper to the tune of about 500 billion naira to keep their operation going. It's a really challenging year for the bank. I mean, there's a lot of pressure from all angles.
What about the other? Let's talk about some other tier 1 banks like Zenith, UBA, and Access Bank, for instance.
Yeah. Okay, Access Bank is one of our top banks. I mean, they've been able to shield themselves from the pressure that I mentioned, most especially exposure to oil and gas and some high-risk sector. I think for them, they were smart enough with some of the foreign currency capital that they raised about 2-3 years ago.